Hey, awesome traders of prime risk. Pretty much every trader out there grinding in the financial markets knows this scene all too well. Trading range. Yup, nailed it. It's probably one of those cycles that's caused a ton of losses for traders. Most folks, when the market slips into this trading range vibe, get super stressed and freaked out. Why? Because they're likely about to take a hit and get caught in the market's trap. They're always wondering, which way is this trading range gonna break? But here's the good news. Today, I'm gonna spill the beans and share some cool tips about trading ranges. When you spot one, instead of panicking, you'll be stoked. You'll know exactly what the market's up to and how to read its moves so you can rake in some sweet profits. So, stick around till the end of this video, because you're about to become a trading range pro and figure out which way the market's gonna break out. That's right, the million-dollar question is about to get answered. From the perspective of market cycles, the trading range is the third main cycle in the market. That means after a spike, we usually see a channel forming, and then the market moves into a trading range. But it's not set in stone that the market always follows this exact order. Sometimes we might jump straight from a spike into a trading range, or after a trading range, the price could slip into a channel phase without forming a spike. All these scenarios can happen. Still, the general market cycle we know is spike, channel, and then trading range. Types of trading ranges. Most people think that when we talk about a trading range, it's just one thing. Anytime the price makes equal highs and lows, boom, it's a trading range. They assume the way to trade it is super straightforward. Just sell at the highs and buy at the lows. But here's the kicker. The main reason why so many folks get trapped in trading ranges is this simple oversight. They don't even realize there are different types of trading ranges out there. Small trading range. One of the most common types you'll spot in the market is this small TR. Here's how it goes. The price makes a spike and then it churns out a few candles that get stuck inside each other, forming a tight little trading range. Here's the key thing to know about this type of TR. The usual rule of sell at the highs, buy at the lows doesn't work here. You're probably wondering, why not? Well, the reason is that small TRs are like a hotspot where a chunk of liquidity builds up. That liquidity is about to get broken soon. So, if you want to trade these small TRs, you've got to play the breakout. Jump into a position in the direction of the break because these setups can give you a super high win rate. Let's look at an example. Say the price makes a spike and then slips into a small TR. Your job is to draw the boundaries of this trading range and get ready for the breakout. Important note. The price needs to break this range with a candle close. If a candle breaks the range but then comes back inside and closes within the range, that's not a valid breakout. It's gotta break clean with a proper close. Second tip. When drawing the boundaries of a small TR, since we're looking for a breakout, it's better to draw the range based on the shadows, wicks, of the candles. That way, you're ready for the move. Large trading range. As the name suggests, these are the bigger TRs where the price gets stuck for a longer time, bouncing between a defined high and low range. It just keeps ping-ponging between those levels. Key tip. When drawing large TRs, unlike small TRs where we use the shadows, here we use the candle closes to mark the boundaries. Second tip. In large TRs, fake breakouts happen way more often. Generally speaking, about 80% of the price's attempts to break out of these ranges fail. So, if you're trading large TRs, you're better off looking for fake breakouts to take positions, as they tend to have a higher win rate. But hey, the question we mentioned at the beginning of the video is this: When a trading range TR forms, which side is it more likely to break out from? Keep in mind, I'm talking about probability here because we always have to consider the odds. So, how do we figure out which way the price might break out of the TR without falling into a trap? I'll explain this theoretically for you. When the previous trend was upward, like say we had an upward spike, and then the price forms a trading range, the upper band of that TR has more importance and validity. In most cases with this kind of TR, the price tends to break out from the lower band and head downward. Another example is when the price first builds a downward trend and then enters a TR. In that case, the lower band has more credibility, and the price is more likely to break out from the upper band of the TR. I want you to take this concept you've just picked up and check it out for yourself in the market. Go ahead and look at several different TRs. See which side most trading ranges break out from and exit the range. Check if the previous trend for that TR was upward or downward, and you'll discover this key point on your own. But why is it that when the previous trend was upward and a TR forms, we say it's probably going to break from the lower band? Well, when buyers were pushing the price up, they reached a certain level and got stopped there. Then the next high forms in the same area, creating two equal highs. That means there was an important zone that didn't let the buyers continue their move anymore. So now the price wants to reverse and break out downward. So make sure to go and check out this exact tip I just mentioned, and you'll see how much more predictable trading ranges become once you know this. So, if you've liked the video so far and the tips I've shared, please give it a like. That way we get some energy too and can make even better videos with more tips for you, helping you level up your trading skills day by day. Directional trading ranges. These fall under the category of larger trading ranges, but the difference is that in this structural pattern, the price starts to move in a specific direction. When the price enters a trading range phase after forming one or two equal highs and lows, it begins to create, for example, lower highs. This means each new high formed within this TR range is lower than the previous one. So, how should we trade these patterns? In these types of trading ranges, most of the time, the price breaks out in the direction it's been leaning toward. So, when the price keeps forming lower highs compared to the previous ones, we need to be ready for the likelihood that the price will break the trading range from the lower side. Now, why does this happen? When the price hits the lower band of the TR, buyers push the price upward. The next time the price reaches the lower band, buyers step in again, but this time they can't even reach the previous high, and they push the price up less than before. What does this mean? It means the buying pressure is getting weaker and weaker, while the selling pressure is increasing. As a result, the price is likely to break the trading range from the lower side. I hope you make the best use of these tips and apply them in your trades. Don't forget to subscribe to your channel, Prime Risk, so you don't miss out on new videos. See you soon.